everyone, and welcome to the JMCO channel. Today I am here with Daniel Roccanti. Hi, Daniel. How are you?
Hi, Faith.
All right, so let's get right into it. We got a lot of questions to cover. So today's topic is tax planning beyond April, year-round strategies for real estate owners. The first question is, why is reactive tax filing costing real estate owners more than they realize?
So I think a lot of taxpayers, they only think about taxes one time a year. And it's like, I got to file a tax return. And so that kind of mindset is just really limiting your opportunities. And so the real loss is an opportunity loss or your opportunity cost. Because most high value decisions, they have to be made before the end of the year. Okay. And it takes time for that. So if you're only thinking about taxes and what can I do and strategizing around that after the year's already done, you've probably missed out on significant amount of opportunities and you don't even know it. And so it's really important that you understand like, hey, and now I need to be thinking about tax strategy year round, not just during tax filing season. And now that tax filing season is over, this is the great time to start thinking about 2026 and beyond.
Right, exactly. Are there strong alternatives to the 1031 exchanges owners should consider?
So 1031 exchange is very powerful. All right. Most people in real estate already know what that is. I can basically sell my real estate and buy a new piece of real estate tax free. And I'm just deferring that gain to it. But it's not always the best answer. There's very strict guidelines around it. Some quick alternatives is it's technically still a 1031 exchange, but you can actually 1031 exchange into a DST. So instead of buying that, owning that property yourself, managing it. Delaware statutory trust is what they call it. It's basically like owning a portion of real estate that somebody else manages. Great opportunity for wanting to switch from active to passive real estate investing, especially if you have people like you're getting up there in age, you don't really want to take care of it, and you're starting to think about the next generation and they don't really want to take care of real estate. Great ways of not having to sell that real estate, pick up the taxes, but still fit in your overall plan. There's also installment sales, so it's not going to defer it forever, but that way I don't have to start paying the whole thing. I can just sell it on an installment sale and I get paid out over time. So like owner financing kind of stuff. Qualified opportunity zones are back. So if you've seen the new tax bill that came out, last year. Basically, this is going to be huge starting in 2027. It's Opportunity Zones 2.0 is what they're calling it. So it's technically all new. The old Opportunity Zones phase out. This new Opportunity Zone starts, and it comes with some a lot of the same benefits that we already have, but some new additional ones. And then one that gets overlooked a lot is what we call a Section 721 or UPREIT contribution. You can actually contribute property into another partnership tax-free. And so if you don't want to just sell the property and buy a new property your own, kind of like a DST, you can actually find like a syndication or a real estate fund out there and contribute your property in exchange for ownership in that. And now you have ownership into this huge real estate fund and by doing this tax-free contribution into it.
Oh, that's amazing. I think you just taught me things. Oh my God. Wow. How are SALT limitations impacting real estate investors right now?
SALT limitations is very geographical. Okay. If you're in New York, you're in California where you have high SALT taxes. Florida, we don't see it as much, but basically what happened was the cap got increased from 10,000 to potentially 40,000. Okay. But it starts phasing out pretty quickly. So high income earners are phasing out and going back to that $10,000. There's a lot of tricks with like pass-through entity tax elections that we do on the business side, things like that to kind of get around it. So we'll see where the SALT limitation, it doesn't affect Florida as much, but definitely if you're starting to invest in areas that have high SALT tax stuff, things like that, it could. I still think at the end of the day, investors are just looking for where's the most profitable places. The places with the highest SALT taxes right now currently are not. They're just not the most profitable. And there's can be other things like rent control. There's a lot more going on that. So I think at the state level, it really comes back to, is that state going to be real estate and investor friendly? And what is the profits looking like in that area? Like even in Florida here, I mean, it's completely different of like what's happening in Miami to what's happening in Jacksonville. So even within a state. So I'm not seeing as much in Florida, but I know there's a little bit of relief for people that are in more like high income state taxes.
I know I've been seeing, because I'm a Florida resident as well, and I've been seeing the shift go from like Miami to Boca to Del Rey. Now we're seeing Boynton. It's like slowly just making its way up the state when it comes to, Hope Sound, I've heard, Port St. Lucie. Like, I mean, real estate is definitely growing quicker here than I think a lot of people realize, which is exciting for a lot of investors too.
It is, and if you're down in the South Florida area, like if you've been to Miami, there's only so much. Like it's already packed to the Everglades and to the beaches, so you can only go up vertically, or you got to start expanding into the other areas.
Yeah, absolutely. Where do you see owners missing proactive planning opportunities?
So what I think a lot of owners are missing here is they think there's going to be just like some like exotic opportunity out there that they've never heard of. And most misses are just these common basic planning, but it takes time. I need to know like what's going on and come into it. I think people get like, I don't know, over glorified. Like, hey, there's just going to be like, I'm going to have I'm going to mention some random IRS tax code, and it's going to save you a bunch of money. And that's not really how it is. It's like there's a bunch of tools in the tool bag, and you need to understand what these strategies do and how they affect your situation that comes in. And so a lot of times it's more being like, all right, what are you doing with yours? All these tax strategies, all these savings, they're they're not saving you money because, let's be honest, the government's not saving you money because it wants to have you pay less taxes. There's a reason, all right? What's the reason? What are they trying to get? Is that something that matches with what you're trying to do? So a lot of times with people, they're just missing out on the opportunities because they're just expecting it to be some grand thing where you come in and you save a bunch of taxes immediately. It's often not sexy at all. It's more about planning out years in advance, and even things simple as like, this year you're going to have a very low tax year, and so we actually are going to push a lot of things off in the future tax years when you sell a bunch of properties, and you're going to have a much higher tax rate. Just playing with tax rates from like a 20% tax rate to a 37% tax rate, 17% difference. That will pure alone by just playing with the timing has saved people millions of dollars.
Wow, that's incredible. So the next question is, how can tax strategy reduce overall risk, not just liability?
So I think when people think taxes, they just think tax liability. Like, how much am I going to pay? How can I make that lower? But you got to really think of it from a lot of difference. One is audit risk. Okay. It's very expensive to get audited. Okay. Very time consuming. It can last many years. So you really want to make sure that you're lowering your audit risk. And it's just by basically understanding what is the IRS looking at. You might not be intentionally trying to do anything to get audited, okay? But if you're working with an experienced preparer, we know exactly what a tax return should look like, what should be reported, what's the red flags, so that you don't accidentally get basically audited because you got a red flag on your return. So, and then and when you do get audited, they're going to start looking at everything. Okay. And so then it's also a legal risk, so things like that. There's a lot of different risks here, so you just want to make sure that you have properly doing your tax returns, proper records, make sure you're having clean books, depreciation schedules, how you're recording everything. All of this affects your overall tax liability and gets overlooked. Bookkeeping, great bookkeeping is the biggest difference between people saving a lot of taxes and people paying a lot of taxes, and they don't know it because they don't know how much they're saving. To give you an example here, so say I go to the store and I want to buy something, they're going to sell it to me for $100, but it's 25% off, so I'm only paying 75, right? I got a good deal. I got 25% off. I just saved $25. I go to a different store, they're selling the same item, $75, no discount. I got the same value, but I think I got more because I got a 25% discount overall. That's what normal human thinking is. And so a lot of times with bookkeeping, you don't realize how much money you're saving by basically overlooking bookkeeping because you never knew that you were saving it in the first place.
How many messes have you had to clean up?
Bookkeeping is one. It's always terrible when we have a clean books. The tax return goes well. You actually save more money on tax liability, tax preparation fees, less risk about which audits, legal stuff. Like even if you get sued for like a legal purpose, having clean books when they're going through it, it just makes everything in your life smoother and easier. Just make sure you care about your books. Messy books feels like you're saving $1 today for potentially spending lots more money down the road.
Absolutely. What should owners be doing mid-year to stay ahead?
So mid-year is actually prime tax planning season. Okay, tax season happens where everyone, CPAs, clients, everyone, taxpayers, we're all worried about getting those tax returns report done. Okay, mid-year is usually the best combination of, all right, last year's done, so now I can fully focus on this year, and I have enough time to start actually doing anything. Because there's a lot of tax strategies, you can't just all of a sudden do something. It takes time. You have to understand. So you want to make sure now is a good time you analyze your business or whatever you're doing. Like if I want to be a real estate professional status, I need to truly understand what does it mean to be a real estate professional for tax purposes. Okay, do I have the hours? Do I have the logs? A lot of times what I see people do is, I've heard about real estate professional status. I bought a rental property. Let's take it. I'm like, whoa, we need to step back here. Did you actually do any of this stuff? And then they'll come up with a bunch of things, and some of it maybe is eligible, some of it's not, and they're usually falling short. And I have to be the bad guy that tells them, hey, you're too late. You're not going to be able to take it. I know someone on TikTok said you could. Unfortunately, you can't. And so then we push that off. Now, next year, we're having to be like, all right, really understand what you need to do. And maybe you need to switch your situation. Buying one or two rental properties might not be enough to get real estate professional status. You might need to go out there and buy more if that's really what you want to do. But you're going to need to understand the time commitment, the lifestyle commitment to wanting to do that. It's not just a one time, I'm taking this real estate professional status and I don't ever have to think about it again. It's every year I need to make sure I'm getting my hours and my proper eligible hours into it.
Yeah, and I think the thing to remember, and I know sometimes with like older people, which is fine, they don't realize that about 80% of what's on TikTok is made by AI. And you could be listening and following to an expert CPA in real estate, and it is someone who is not real. So I definitely think working with a real person like Daniel and an expert will save you in the long run.
Anything social media, it's a mixed bag. There's actually good advice. You just don't know when you're getting good advice and when you're getting bad advice. And that's the biggest problem with people is just information nowadays. It's just hard to decipher what's real, what's not. And so when that happens, you just, you got to fact check everything. And if you don't know it or it's very complicated, that's why I usually recommend if you do hear anything on social media, check it with your CPA before you do anything.
Oh my word, 100%. And I didn't mean to say old people too, because my 11-year-old believes everything on social media as well. So it's fine. It's everyone. Just check first with a professional before.
Those AI videos are getting better every day, I promise.
Yes, they 100% are. Okay, so last question. What's one move real estate owners should make before year end?
So the biggest thing we want to do is actually analyze all our properties. Okay, this is the time to do it. So before you're in, let's look at every property and say, all right, would I buy this property today if I could start over? All right, is this property doing well? Is it cash flowing? Is it getting the return I want? Really need to look at each property and where it actually is today and decide, do I like this investment or should I start looking for a different? I have enough time. Real estate, you can't just buy and sell quickly, but I have a half a year to start doing that. And real estate really is a year. So when you're looking at your properties, you should really map everything out before you buy it. The best investors have an exit strategy before they've ever purchased the property. Okay, they understand how they're going to buy it, how they're going to operate it, and how they're going to exit it. Yes, life throws wrenches at you and you got to change things as you go, but that's okay. But as long as we have a plan, and then you need to be assessing your properties every year and really understanding. And then, when you're reviewing your properties, then that's when you can start really digging down with your CPA of tax strategies, bonus depreciation, cost segregations, 1031 exchanges, or if you're getting into like even more complicated stuff like the rehabilitation, like the historic rehabilitation tax credit, because I like to rehab historical properties. You start getting into what the complexity of that, does it really fit what you're doing, and is the cost savings worth it? I always tell all my clients, return on investment is great, but sometimes return on hassle is even better metric. We all want to save money, but do we really, really want to make, at the end of the day, work and do all this different activity to save $5? Truly understand what your return is, not just on investment, also on hassle and everything, what the cost is, what the savings are, to really see if it fits your strategy and your lifestyle.
I love that. Solid advice. Well, it was so great to talk to you today, Daniel. Thanks for everything. And we will have you back on the JMCO channel May 28th. Yes, May 28th. And can't look forward to talk to you again.
Looking forward to it. Thank you.